Hi, I'm Tom Lydon in Hollywood, Florida at the Inside ETF Conference here with Vince Birley, CEO of Vident Financial. Great seeing you, Vince.
Great seeing you, Tom.
So there's a lot of discussion about alternative strategies. Let's dig into one of them, real estate. What's the outlook for real estate? Why does it make sense to think about today?
Yeah, so real estate has been one of the better asset classes over time, but it's been a bit forgotten of late because everything's been running out on quality and momentum and growth and FANG.
Yeah.
And so real estate hasn't been really given much attention until really the fourth quarter of last year when real estate was only down about 7.5%.
Yes.
And the S&P was down 14.5%. And all of a sudden people are wondering, maybe it's time to get back into real estate.
Yeah. And you folks took a really unique approach in a real estate offering in PPTY. Let's talk about that.
Yeah, so we were approached by a wealth management firm that wanted an ETF that was actually exposed to real estate. And we thought, well, there's plenty of those out there.
Yeah.
And then we found out that actually they're just focused on the REIT rather than the underlying real estate. And so what we did is that they wanted to know what are the attributes of real estate that we should pay attention to in an index. We're known for looking at actually the long-term fundamentals of different asset classes, and location came to mind with real estate, what kind of property types, and then leverage levels. And so we actually reverse engineered and looked at the underlying real estate to give us the proper exposures to those different asset classes.
Okay, so types of real estate and location. How does that construction come together? What does that look like?
Yeah, so what we do is there's about 100,000 properties in public REITs. And so we said, okay, we want to target an actual property type allocation. And so we said, okay, we don't necessarily think retail maybe is the future. Industrial might be with e-commerce. Mm-hmm. Well, when you buy a typical ETF in real estate, you own mainly retail.
Right.
You own a lot of concentration in particular cities, like office space is mainly New York and Boston, like 40%. Well, we have half of that to get further diversification. And then we also really look at leverage because the one blow up risk in REITs is too much leverage. So we eliminate the high leveraged REITs.
Got you. So a lot of investors who might have buy other real estate funds or even ETFs don't know this high concentration in those areas.
Right. So a lot of our work is educating the marketplace on the difference between looking at the fundamentals of real estate in an index versus just buying the REIT index.
Absolutely. And what a great vehicle in the ETF to be able to do this.
It's perfect. I mean, because you can get a rules-based engine that actually just rebalances. So like, for instance, last year, Blackstone bought a big industrial REIT, took it off the market. And all of a sudden, the REIT index was way underweight industrial. Our product actually rebalanced to get the industrial allocation back up to where it should be.
Where all the funds that owned it were messed up.
All messed up.
Vince, great. I really enjoyed it.
Absolutely.
Good seeing you.
Thank you.
Thank you.
Bye-bye.